How do you build a property portfolio in 2025? Building a property portfolio today is much harder than it was 10 years ago. So how do you get started and how do you build it out? That's what this video is all about. Hi, for those of you who don't know me, my name is Jathu. I'm a buyer's agent for property investors and I buy properties all around the country using a data-driven approach. So if you want to work with me, go to my website propertybuyersagency.com.au and book a session with me there. Now, if you look at YouTube, you will see several videos about people talking about how to build property portfolios. They talk about how you can buy one property and then use the equity from that property to buy the second property and keep on doing this until you get multiple properties. But the thing that they don't talk about is the restrictions that you have with borrowing capacity. So you are not able to just use equity and keep on buying multiple properties because borrowing capacities are much different now than it was 10 years ago. So what we're going to break down here is why it was easier to buy properties 10 years ago, what has actually changed, and what you need to do today to actually start buying multiple properties. Okay, that's what this video is about. Now let's go back 10 years ago, right? Why was it easy to buy properties? And that's because lending rules were much more lenient. People could just buy properties, and as long as they were positively geared, banks would just lend them more money. And so they could repeatedly use this strategy to buy multiple properties. And most people who bought properties back, 10 years ago and bought multiple properties on an average income were able to buy properties for under 200,000 in capital cities with about a 7% rental yields. So these were growth properties having good cash flow as well. So the banks had no problems in lending them more money to buy multiple properties. But that's no longer the case, okay? And this strategy cannot be used to buy properties anymore. And that's because APRA introduced some changes, okay? Today, if you buy a property, the banks will look at it differently, okay? So if you have an interest rate, let's say 6.5%, the banks will assess you at 9.5%. They apply a 3% serviceability buffer. Number two, even if you're on interest only, what the banks would do is that they will take 5 years interest only and then assume that you're going to be 25 years principal and interest, and they will calculate your repayments based off those principal and interest repayments. So your actual repayments, as seen by the bank, is going to be much higher than your actual repayments. So on paper, your property might be positively geared, but in the bank's eyes, this is a very heavily negatively geared property. Okay, and that means the banks are not really happy to lend you more money, and therefore borrowing becomes harder. And on top of that, they now scrutinize living expenses much more closely, which means that it's becoming more and more harder for them to lend money to investors. So that means the strategies have changed. Okay, what was working 10 years ago cannot be used anymore. People who bought, properties over the last 2 to 3 years actually did so because they had a healthy income. They used their incomes to buy multiple properties. That means there's a very high significance placed on your income to build out a property portfolio in today's environment. So does it mean that all is lost for someone who is on an average income and is having dreams of building out a portfolio? Not exactly. It is much harder, but if you are strategic about it, then there is still a way to do this. Okay, so let's take someone who is on an average income. Let's say they have $90,000 average income and they've got a borrowing capacity of $550,000. They don't have a home or they don't have any other debts or credit cards, etc. Now, if they go out and buy a $500,000 property, that's it. They don't have any more borrowing capacity to buy more properties. So you can't just go out and buy a property and expect to be able to buy more properties after that. So you have to take on a different approach. So if you're on an average income, you have to then look at alternative approaches like buying properties under a trust with a corporate trustee. Now, why you want to use this approach is that when you have a property under a trust with a corporate trustee, banks can ignore the debt on this property as long as you can get an accountant to certify that the property is a non-trading entity which can take care of itself. Okay, and since they are ignoring the debt on this property, you still preserve that 550,000 borrowing capacity, which can be used for property 2, property 3, property 4, and so on, as long as the accountant is certifying that each property is taking care of itself. How can you get that accountant letter? That's the big question. In today's interest rate environment, most properties are negatively geared. So most accountants are not going to be very comfortable giving you that letter. But if you speak to different accountants, you'll see that they have different perspectives around this matter. Some are happy to give you that letter, taking into fact that the beneficiaries can inject capital into the trust. The trust is now taking care of itself. And on top of that, if they find that the shortfall is around $5,000 to $10,000, something that is manageable by the beneficiaries, they might give you that letter saying that the property is taking care of itself. This is not financial advice. Okay, please do speak to an accountant about your own situation, how comfortable they are with giving that letter. So that's why it becomes important for you to speak to different accountants before going down this path. You also have to speak to a mortgage broker, because not all mortgage brokers are experienced in this type of thing. So work with someone who really understands how you can buy properties under trust. Okay, so the accountant and the mortgage broker become really important people in this activity. So let's say you buy a property for 450,000, right? There are still some things that you need to take note of. When you buy a property under a trust, you don't have any negative gearing, so you can't claim tax on any negative gearing. So which means that money that has been lost is lost, and you can't claim that back until you can offset that with any positive income coming from the trust. So that's a big negative that you have to factor in. Look at that 450,000 property purchase. The rental income is about 24,960, assuming that it gives 480 per week in rent. We have our loan repayments, property management fee, insurances, council rates, and under the maintenance costs are factored in the annual fee that you have to pay to maintain the trust. It's around 1,200, but that could vary. So you're already seeing that the annual cash flow is negative 10,916, negative 10,000. So let's say you buy 3 properties under a trust. Okay, using this strategy, you can see this cash flow here. We're now sitting at negative 32,000 for the first year. Now, with someone who is earning 90,000 gross income, 32,000 is a significant portion of that income being allocated towards your properties, okay? Which means that you're going to make a lot of sacrifice in terms of your lifestyle and the way you live, okay? So it's not going to be possible if you don't make these sacrifices. And since we're negatively geared, we're not going to buy any other properties for a while, okay? And so the 4th property purchase only comes in year 7. In year 7, we buy a $500,000 property using the equity gain from properties 1 to 3, and then you see our cash flow drops to around 36,000 negative. Okay, and again, we don't buy properties for a while, and year 10 we buy a property under a trust again, a $500,000 property, and you can see the cash flow has dropped to 41,000. Hopefully your income has risen to by some extent, but by this time, and therefore this negative cash flow is more manageable for you. So you can see here, we are not being too aggressive because we can't manage that negative cash flow. If you do, it'll affect your lifestyle in a big way. So if you just follow this cash flow trend here, you can see that the positive properties can pay themselves off by year 19 because rents are increasing. And so let's say at year 19, what you do is you sell off property 1 and 2. So property 1 is valued at 1.36 million. It has a debt of 0.4 million. You make a profit of 0.95 million. And the same with property 2 as well. After factoring in capital gains tax, you make a profit of 1.5 million selling off those 2 properties. So the debt on properties 3, 4, 5 is still at 1.4 million. So you have enough funds to cover off the debt on the 3 properties. So now you have property 3 3, 4, and 5, which are debt free and which is able to generate you passive income of around $79,000. So $79,000, it's not a significant amount. It's a decent amount, but not a significant amount. And it's taken you nearly 20 years to do this. The reason is because the income isn't high enough for you to support buying properties more aggressively in a shorter time frame. So then again, it comes back to that income. The higher the income, the faster you can accumulate those properties, and you can sustain the negative cash flow, and you can achieve higher passive income targets in a shorter period of time. Okay, and even if you're employing this strategy, it can't be just a buy and hold strategy. You have to be a bit more active around it. Buy properties where you can add value so that you get instant equity, you can increase the rents on the property. Number 2, buy properties which have subdivision potential so that you can sell off the land at the back and then use that profit to pay down debts on your existing properties. In that way, your cash flow will also improve. So it has to be a kind of an active strategy. So these are some things that you could do, and I think this is probably the only way you could buy properties if your income isn't going to increase significantly and you have ambitions of building out a big property portfolio. This is probably the only way you're going to do it in 2025. So I hope you found these tips useful. If you like the content, please like and subscribe to my channel, and I'll see you in my next video.